Are you ready to navigate the latest economic shifts?
Experts like Joseph Wang, Nick Gerli, Jeff Snider from Eurodollar University, Gordon and Douglas Macgregor have been dissecting complex market trends all week.
Now we've distilled their key findings into quick, AI-powered summaries.
Joseph Wang begins with an analysis of current market conditions. Just a reminder that this content is for informational purposes only and not investment advice.
Today, we're examining Joseph Wang's analysis of the current market conditions from his Markets Weekly video, dated February 8th, 2025.
Joseph Wang is known for his in-depth understanding of market trends and his ability to provide actionable insights for investors.
Joseph Wang discusses current market trends and potential future impacts.
Let's delve into some key points from Wang's discussion and see what conclusions we can draw.
Joseph Wang discusses the importance of understanding global economic trends.
He notes that events like changes in interest rates and trade agreements can have ripple effects across markets.
According to Joseph Wang, central bank policies play a pivotal role in shaping market behavior.
Decisions regarding interest rates and quantitative easing can impact borrowing costs and asset prices.
Joseph Wang emphasizes the significance of investor sentiment in driving market dynamics.
Optimism or pessimism among investors can influence buying and selling decisions, affecting market direction.
Joseph Wang points out that bond yields play a crucial role in shaping market sentiment.
Rising yields can indicate changing expectations about inflation and economic growth affecting asset valuations.
According to Joseph Wang, currency valuations have significant implications for international trade and investment flows.
A stronger dollar, for instance, can make U.S. exports more expensive and impact the earnings of multinational corporations.
Joseph Wang suggests investors should monitor volatility indices like the VIX to gauge market risk.
Increased volatility can signal uncertainty and prompt investors to reevaluate their portfolios.
Joseph Wang anticipates a period of increased market volatility due to uncertainty surrounding economic policies.
He advises investors to prepare for potential market swings and consider strategies to mitigate risk.
Joseph Wang highlights the potential for certain sectors to outperform others based on changing consumer preferences.
He suggests identifying sectors poised for growth and adjusting portfolio allocations accordingly.
Joseph Wang emphasizes the importance of understanding current market dynamics and how they differ from historical patterns.
According to Joseph, the market's behavior is heavily influenced by various factors like central bank policies and global economic events.
Wang suggests that investors should closely monitor key economic indicators to make informed decisions.
He also advises staying updated with the latest financial news and expert opinions to navigate the market effectively.
Today, we will dive into an analysis by Nick Gerli, examining a potential shift in the housing market.
Nick's insights could be critical for anyone looking to buy or sell a home in the current climate.
Nick Gerli emphasizes a massive surge in days on market, DOM, reaching levels not seen in over 5 years.
This is a notable shift. Understanding what DOM means is vital for assessing market dynamics.
Nick Gerli's thesis revolves around a significant shift in the housing market, primarily indicated by the DOM surge.
This increase suggests a transition away from the hyper-competitive market conditions seen in recent years.
How does Nick Gerli interpret this DOM surge in relation to market stability?
Nick sees this as a move towards a more sustainable market, where buyers have more power and prices are less likely to be artificially inflated.
What exactly does Nick Gerli say that days on market signifies in real estate?
Nick points out that DOM measures how long a property stays listed before being sold. A higher DOM typically indicates less demand and more supply.
And how does Nick Gerli tie this into the overall market sentiment?
Nick's analysis suggests that rising DOM reflects a shift from a seller's to a more balanced market, giving buyers more leverage.
So as Nick Gerli sees it, what factors are contributing to this surge in DOM?
Nick explains that higher interest rates and increased housing inventory are major factors slowing down sales and increasing DOM.
Based on the DOM trend, what does Nick Gerli predict for home prices in the coming months?
Nick indicates that with rising DOM, we might see a moderation in price increases, potentially leading to price cuts in some areas.
According to Nick Gerli's insights, how should potential buyers strategize in this shifting market?
Nick suggests that buyers should take their time, negotiate more aggressively, and not rush into decisions as inventory increases.
Nick Gerli suggests that the recent surge in DOM indicates a significant cooling in seller exuberance. This could lead to more balanced negotiations.
That's right. It's a signal for potential buyers to approach the market with a bit more confidence.
Nick also highlights the importance of monitoring inventory levels and buyer traffic as leading indicators. Keeping an eye on these stats can provide a good feel of what's to come.
Absolutely. Awareness and data analysis are key tools in navigating this changing market.
Today, we're discussing the implications of Mexico's recent emergency rate cut, as analyzed by Jeff Snider of Eurodollar University.
Jeff Snider is an expert in the Eurodollar system and its influence on global monetary policy. His insights are crucial for understanding these events.
Snider's analysis suggests this move may signal broader global economic concerns.
Exactly. It's not just about Mexico, it's about what this action reveals about the global financial system.
Jeff Snider's thesis centers around the idea that Mexico's emergency rate cut is a symptom of deeper issues within the Eurodollar system.
According to Jeff, this action reflects underlying stresses and potential liquidity problems in global financial markets.
Snider argues that this cut could foreshadow similar actions by other central banks worldwide.
He believes that these moves are indicative of broader economic vulnerabilities and potential contagion effects.
Jeff Snider notes that emerging markets are particularly vulnerable due to their reliance on dollar funding.
That's because many emerging market countries borrow heavily in US dollars, making them sensitive to dollar fluctuations and interest rate changes.
Snider explains that a stronger dollar can lead to capital outflows from these economies, exacerbating their economic problems.
This can create a vicious cycle where capital flight leads to currency depreciation, higher inflation, and further economic instability.
Jeff Snider points out that the decline in oil prices often reflects a decrease in global demand.
Lower oil prices can also strain the budgets of oil-exporting countries, adding to global economic pressures.
Snider highlights that these factors are interconnected and can amplify the effects of a global economic slowdown.
Indeed, the Eurodollar system plays a significant role in these dynamics, influencing both currency values and commodity prices.
Jeff Snider suggests that further emergency rate cuts by other central banks are possible if economic conditions worsen.
This could indicate a broader concern among policymakers about global economic stability.
Snider also notes that these actions might not be enough to reverse the underlying economic trends, given the limitations of monetary policy.
Ultimately, addressing the structural issues in the global economy is crucial for sustainable recovery.
Jeff Snider emphasizes that understanding the Eurodollar system's influence is crucial for interpreting global market movements.
That's right. Investors should pay close attention to the signals coming from this market, as it often anticipates policy changes and economic shifts.
Snider highlights the potential for further emergency rate cuts if global economic conditions continue to deteriorate.
So keeping an eye on global growth indicators and central bank actions will be key.
Today, we'll dissect an analysis by Gordon Long on the potential for a major stock market downturn, as discussed with Adam Taggart.
Gordon Long brings a wealth of experience in macroeconomics and financial history, setting the stage for a thought-provoking discussion.
Adam Taggart's role as a keen observer of economic trends provides additional depth to the conversation.
Their combined insights offer a comprehensive view of current market conditions and potential future scenarios.
Gordon Long argues that the convergence of excessive debt, distorted asset prices, and historical patterns indicates an impending market downturn.
Adam Taggart emphasizes the importance of understanding these factors to prepare for potential financial challenges.
Adam Taggart notes that current market conditions are unsustainable and mirror those preceding previous major crises.
According to Gordon Long, recognizing these similarities is crucial for risk management and financial planning.
Gordon Long points to excessive debt levels as a critical factor that could trigger a market collapse.
According to Gordon, unsustainable debt burdens increase the vulnerability of the financial system to economic shocks.
Adam Taggart notes the role of quantitative easing and other monetary policies in distorting asset prices.
Gordon Long's perspective is that these distortions set the stage for a significant market correction.
Gordon Long suggests that these conditions mirror historical patterns of financial crises, indicating heightened risk.
Adam Taggart also emphasizes the importance of recognizing these historical parallels to anticipate potential market behaviors.
Gordon Long predicts a substantial market correction driven by unsustainable debt and policy distortions.
Adam Taggart mentions that while the timing is uncertain, the underlying conditions suggest that a significant downturn is increasingly likely.
Adam Taggart suggests that investor sentiment and market indicators need close monitoring to gauge the timing and severity of the downturn.
According to Gordon Long's analysis, the depth of the correction could rival historical crises, making preparation essential.
Adam Taggart's analysis underscores the importance of understanding the current economic climate and how it might affect investment strategies.
Gordon Long suggests being prepared for significant market volatility and potential downturns.
Adam Taggart advocates for cautious financial planning and risk management to navigate uncertain times.
Gordon Long's emphasis on historical patterns implies that drastic changes are coming, necessitating careful preparation.
Diversification and hedging strategies are critical, as highlighted by Adam Taggart, to protect against substantial losses in a downturn.
Gordon Long's perspective suggests considering alternative investments and safe haven assets to preserve capital during turbulent times.
Today, we're diving into a discussion with Douglas Macgregor, a former Army colonel, as featured on David Lin's channel regarding America's biggest threats and potential future conflicts.
Macgregor brings a wealth of experience in military strategy and geopolitical analysis to the conversation.
Douglas Macgregor has a distinguished career in the armed forces.
Macgregor is known for his outspoken views on defense policy and military reform.
Douglas Macgregor believes that America's biggest threat lies in overextension and misallocation of resources.
Macgregor's analysis emphasizes the need for a more focused and strategic approach to national security.
Douglas Macgregor suggests that future conflicts will be shaped by economic and geopolitical forces.
According to Macgregor, preparing for these conflicts requires a comprehensive strategy.
Douglas Macgregor emphasizes the need for a reevaluation of America's military readiness in the face of evolving global threats.
Macgregor suggests that current military strategies may not be adequate to address modern challenges.
According to Douglas Macgregor, geopolitical strategy should prioritize key areas of strategic importance.
Macgregor's analysis points to specific regions where American influence needs to be carefully managed to avoid overextension.
David Lin's discussion explores the balance between military spending and economic stability.
Macgregor highlights the importance of ensuring that defense expenditures do not undermine the nation's financial health.
Douglas Macgregor suggests that future conflicts may arise from unexpected sources.
According to Macgregor, it's critical to anticipate and prepare for various potential scenarios.
Douglas Macgregor predicts that economic factors will play an increasingly significant role in shaping geopolitical outcomes.
David Lin's conversation with Macgregor highlights the importance of monitoring economic indicators to anticipate potential crises.
Douglas Macgregor emphasizes the need for a strategic realignment to address current threats effectively.
Macgregor's analysis suggests that focusing on economic stability and internal strength is crucial for long-term security.
David Lin's discussion highlights the interconnectedness of economic policies and military strategies.
Macgregor suggests that prudent fiscal management can reduce vulnerabilities to external pressures.
What an enlightening discussion we just wrapped up.
Absolutely. Each guest brought such sharp insights to the ongoing economic conversation.
We heard Douglas Macgregor highlight how geopolitical tensions shake the very foundations of our economy.
And Gordon Long's point about the financial system being on the brink of a shift really hit home.
Right. And then there's Jeff Snider, diving deep into the Eurodollar system as a key player in economic forecasting.
Plus, Nick Gerli really reminded us that consumer sentiment is just as crucial for recovery.
It's fascinating how they all sense the urgency, yet some of their views clearly diverge.
Exactly, like Douglas's focus on geopolitics versus Gordon's take on systemic shifts, or Jeff focusing on the Eurodollar while Nick emphasizes consumer behavior.
So much to unpack. For those watching, if you found this discussion valuable,
don't forget to like and subscribe. Your support helps us bring more of these insights directly to you.
And stay tuned, because next time we'll tackle even more pressing financial topics that you won't want to miss.
Thanks for joining us, and we'll catch you in the next video.